What is up, everybody? Dan again, Stocktrades.ca. Welcome back to the channel. We've got a very good video today. We're going to go over a very underrated fund here in Canada. But the first thing I want to do is go over the winners of our comment contest. Again, if you comment on the video below, you like the channel, you're subscribed to the channel, every now and then we're going to announce a winner of a premium subscription. It's a $300 a year platform we run over at Stocktrades. Absolutely no gimmicks. I announce a winner, you shoot me an email, and I will get you set up within a few minutes after you send me the email. So we're going to announce the winners of that. If you want to skip it, I will leave a chapter in the video where you can head right to the video. All right, everybody, I went to pickawinner.co. I entered in our two videos, and I picked one comment from each video, and we've got Peter Vigna 3579, and we have Bassion, which is kind of funny because he commented on ZLB, and that is the ETF we're going to be going over today. So again, both of you, if you head to www.stocktrades.ca and head to our contact page and shoot me an email, I will set you up with a subscription. You just have to prove that you own the account, but I'll discuss that all with you when you email me. So please reach out to me as soon as possible and we'll get you set up. So for everybody else, head down below, like the video, subscribe to the channel, and comment. Let me know what fund, what stock, what mutual fund you want me to look at. Absolutely anything. We just gave away $600 in subscriptions just by people commenting on the video. It takes 2 seconds, helps us get more views. So again, head down below, comment what you want me to do next. And in the description below, we have our No BS newsletter. This is a 2 times a week newsletter. It's absolutely free. We're going to go over stock picks, market commentary. We're going to give away free case studies. We do a ton of content, and you're not going to want to miss the newsletter, especially because it's absolutely free. Link in the description to join that. And with that said, let's get into our video on ZLB, one of the most underrated ETFs in Canada. So ZLB, this is one of the most popular funds in Canada, but I also feel that it's a little underrated. Not a lot of people know about it. And that is the BMO Low Volatility Canadian Equity ETF. It trades under ZLB. It's obviously issued by BMO. And this is a actively managed fund. I do not believe it's an index fund because what they do is essentially pick stocks that have lower overall betas volatility than the market. They add them into the portfolio. So the fund has total assets under management of $3.56 billion as of March 2024. It has a 0.35 expense ratio, but I'm not exactly sure which one is correct because if we head over to the fact sheet of BMO and we head down below, we can see that the management expense ratio is 0.39 with a 0.01 trading expense ratio, which leads to total fees of about 0.4. I'm not exactly sure which one is correct, whether it's YCharts or BMO, and the only reason I say this is because this fact sheet is a little out of date. It's as of January 17th, 2024. I'm leaning on the side that it is 0.4. It's going to be the management expense ratio that you see in this fact sheet. Generally, these fact sheets, this is what you want to refer to if you are looking to find out information on the ETF. Take third-party data sites like YCharts as kind of a nice to have, but you want to be verifying your data. So the fund yields around 2.58%. So this isn't necessarily a higher yielding fund, even though you'll see when we go into the holdings, it does contain a lot of blue chip dividend Canadian stocks. Obviously, they're going to be lower volatility because of the mature business model. You're not going to see many small cap companies in this fund. And it's actually been around for quite some time. It actually started in 2011, I believe, and when we look to its total performance, and we'll get more into performance in a bit, this fund has returned since 2011 288.9%, whereas the TSX has only returned 185%. So it has performed exceptionally well, and that just comes from its overall holdings, really, and we'll get into that again in a bit. So when we go down to the fundamentals here, again, yield 2.58%. It holds 52 stocks, so this is a pretty concentrated ETF, but not really considering the fact that we don't really have a lot of large cap blue chips here in Canada. I mean, there's a reason why there's an S&P 500 and only a TSX 60. Our economy, our country overall overall is just really not that big. So we don't really have a lot of selection to go off of. And even the selection we do have, they're hyper concentrated in a particular niche. Talking financials, we're talking telecoms, materials, utilities, things like that. So when we go to the average price to earnings ratio, we get 18.38, which is surprisingly expensive, but a lot of the companies inside this fund have been very strong performers, whereas the Canadian markets overall have just struggled quite a bit. When we look to growth estimates, and I was a little puzzled on the forward price to earnings, especially relative to the forecasted earnings growth, because this should be next year's earnings growth. So it is 1 year forward from today, and they expect that this fund is going to see a decline of 2.58. This means that on average, they're going to see a decline. The holdings in this portfolio are going to see about a 2.58% earnings decline, and this is the reason why this is a bit puzzling to me is because the price to earnings ratio on a forward basis is lower than a trailing basis. So there might be a few outliers in there that are skewing this data a bit. But again, they do expect this fund to struggle on an earnings basis moving forward. We've referenced it in our other videos. I mean, when we look to the S&P 500 as a growth rate, it's expected to grow earnings at a 7 to 8% pace over the next year. So to see a decline in earnings, it's definitely alarming, I guess you could say, relative to the U.S. markets. But when you consider how rough of a shape the TSX is and the Canadian economy is overall, it's really not that surprising to see this decline. When we look to 5-year earnings growth, it does get a bit better. They expect it to grow at around a 6.36% pace in terms of earnings moving forward over the next 5 years. This is an annualized number. Again, this is relatively short of the U.S. markets. I think they're forecasted to grow in the double-digit range annually over the next 5 years. But this is still a relatively strong earnings growth rate from a fund that pretty much contains Canadian blue chip stocks. So let's get into sector makeup and total holdings. If we go over to allocations here, we can see that this is first off, 100% stock fund and a 100% Canadian fund. So there is no U.S. exposure, no international exposure. This is simply a Canadian ETF. When we head down to the market capitalization, you'll see what I mean by the fact that there's very few, actually there's none. There's no small caps in this fund. It contains 40% mid caps, 46% large caps, and 13.51% giant caps. Now, the thing here is Canada doesn't have a lot of giant market capitalization stocks. I mean, we really only have 2 or 3 stocks with market caps over $100 billion. So I believe if we did have more stocks of that size, they would be included in this fund. But for the most part, our large and mid caps, even some of our mid cap companies are considered blue chip stocks. So for this reason, we can see that, it's much more heavily weighted towards the large and mid cap market capitalization. Now, the interesting thing here is going to be on the sector exposure. Now, it's not surprising at all to see financial services at 20% exposure. This is pretty much a guarantee with most Canadian ETFs. You're going to have large financial exposure. First off, a lot of our banks operate on an oligopoly. I mean, they have virtually no competition. That makes them lower volatility. That makes them, relatively strong earnings growers. So they're going to be in this fund. They're going to be very prevalent. But you'll notice that there's no energy exposure, and a ton of our blue chip companies here in Canada, Imperial Oil, Canadian Natural Resources, Enbridge, any sort of pipeline company, TC Energy, they are not inside of this portfolio. Why? Because this is a low volatility fund, and energy stocks are far from low volatility. It does have a lot of industrial exposure. This is going to be to the waste collection companies, to the railroads, things like that. Technology, when we go over the top holdings, I will show you what kind of tech exposure the fund has. And then we have obviously consumer defensive. They're typically lower volatility, so we see that at nearly 18%. And then we got utilities, regulated utilities, things like that. They're going to be lower volatility. But overall, this is more balanced than you would typically see in a lot of Canadian ETFs. I mean, when you go to a lot of Canadian dividend ETFs, you're going to find two things. They have a ton of financial exposure. Some of them are like 50, 60%. And they're going to have a ton of energy exposure, which, over the long run, it doesn't really make them well suited as, core holdings in a portfolio, primarily because they're way too concentrated. But with dividend ETFs, financials, and energy, they are some of the best dividend growth stocks in Canada, so they're included in those funds a lot. So let's go to total holdings. And when we get here, we notice that there, again, is 52 holdings. But the one thing we can see is it places a very heavy reliance on the grocers. Now, this is the holdings list as of January 31st, 2024. When I go to the fact sheet, the holdings list is actually from back in November 2023. So this might not be the overall makeup of this fund, but it's going to be very, very close. They might vary a bit, but not too much. I mean, the fund, it's not to say equal weighted, but when we look from the number one holding to the 25th largest holding, you're talking about a 2% difference in weighting. So the top holding is Loblaws, Metro, Hydro One, Waste Connections, Empire. And if you'll notice, they put a lot of reliance on Canada's grocers. And the one thing is, Canada's grocers, a lot of them are low volatility. I mean, if we head to Loblaws, MRU, and Empire, and we go to their betas, we're going to see that they are low beta stocks. We can see here Loblaws has a 0.157 beta. And if you're unaware of what beta is, it's essentially how the stock moves relative to the market. So you can think of a stock with a beta of 1, it moves relatively in line with the market. A stock with a beta of 2 is going to have twice the volatility as the overall market, and a stock with a beta of 0.15 is going to have about an eighth of the volatility of the total market. So we can see Loblaws a beta of 0.1. We can see Metro's even lower at 0.07, and Empire is at 0.5. I mean, Empire is a little more volatile, especially as of late, because of the overall company makeup. I don't want to get into that right now, but they don't have as much exposure to discount grocers. So as a result, their earnings are a bit more volatile as of late, and their stock price has just been a bit more volatile. But you're going to get the top grocers, and then, as I mentioned, you're going to get industrials like Waste Connections, garbage disposal. The one thing I'm actually surprised to not see is Canada's railroads. They're not in the top 25 holdings on either sheet here. That's actually pretty surprising to me. They must have higher than average betas, and they're not included. But outside of Waste Connections, in terms of utilities, we got Fortis, Hydro One. I bet you we'd have Emera in here. Yeah, we have Emera. We've got Thomson Reuters. We've got TMX Group in terms of, kind of financial type stocks. We have a couple of the telecoms. We have Rogers. We have BCE. We have discount retailers in Dollarama, Restaurant Brands International. That's Tim Hortons, Burger King, all that type of stuff. Intact Financial, they're one of the largest P&C insurers, property and casualty insurers in Canada. Overall, you can kind of get the gist of this fund. A lot of these stocks are blue chip Canadian stocks. They're going to be low volatility. If you head to any of these stocks, they're going to have low betas. And that's primarily what the fund aims to do. So last but not least, how has the fund performed? Ultimately, performance is what it's all about, especially with actively managed funds. And if we go to the fundamental chart here and we add in total return, this fund has done quite well relative to the TSX. If we look to the TSX 60 relative to ZLB, it has outperformed the TSX 60 by quite a wide range over the last 10 years. We're talking in terms of annualized returns, 10.14 versus 8.23. If we were to put this into a growth perspective, growth of $10,000, if you had invested $10,000 10 years ago, today you'd have around $26,290, whereas if you had just bought a TSX index fund like XIU, you would have $22,000. You'd actually have a little bit less due to the fees of XIU. This is just a strict index growth. So it has outperformed the TSX index, and when we go to actual total results, it actually gets a bit wider. This fund has returned 11.54% annualized versus 8.8% with the TSX 60, which ultimately would lead to you having 39,000 with ZLB, where you'd only have around 28.5 with a TSX 60 index fund. Now, when we compare this to the S&P 500, it's highly unlikely that this is kept up to the S&P, but it's probably done a reasonably good job. So we're looking at, the S&P over the last while since this fund has been started has just absolutely ripped, 14.45% annualized versus 11.54. But the thing is, you're talking about a basket of low volatility Canadian stocks versus the S&P 500, which primarily has been absolutely driven by the big tech, the run up in big tech. And when we actually look to the returns from a percent basis, this fund actually ended up doing quite well compared to the S&P 500 up until the COVID-19 pandemic. We can see it kept pace here for the most part until we hit the COVID drop, and then it started to struggle. So you're not going to get, well, at least you have it in the past, S&P 500 US-based returns, but this is a Canadian fund. It's a concentrated fund. It's a low volatility fund, and it's done quite well. So I guess I'll finish off the video by kind of highlighting my opinion on whether or not I believe ZLB will do well moving forward. And I would argue that the fund benefited from a post-financial crisis of ultra-low interest rates. A lot of these companies are rate sensitive. When we look to the banks, when we look to the telecoms, when we look to the regulated utilities or just utilities in general, they're very interest rate sensitive. They benefited a lot, maybe not necessarily the banks, but I'll speak about why the banks might not benefit in this environment moving forward. But in terms of telecoms and utilities, they've had quite a long run of very cheap money, which allowed them to expand, allowed them to grow earnings. And now we're sitting in this environment today with 5% policy rates. We don't know how low they're going to go, but we can be pretty sure they're not going to go down to what they used to be. So as a result, you might see some of these companies struggle moving forward. So in turn, this fund might struggle. In regards to the banks, they typically benefit in a higher rate environment. But right now, at least in the near future, we've got very high policy rates. We've got a pretty rough economy here in Canada. Provisions for credit losses are hitting earnings pretty hard. So it's difficult to say whether or not the banks will perform well moving forward just because of this environment. For the most part, though, most of the holdings inside of this fund should be able to perform well even in the environment we're in. Again, the negative earnings decline expected over the next year is not all that surprising considering the Canadian economy, considering some of the holdings within this fund. But overall, it's performed quite well. If you're looking for a low volatility fund that pays a reasonable dividend, 2.58%, I think it is, it's not that bad of an option. It's got $3.5 billion in assets under management, so it's quite a big fund. There's a ton of liquidity here. All these underlying holdings are, they have a ton of volume. You're not going to have any issue trading in and out of it. And overall, I think it's a pretty neat fund. So that's pretty much it for the video, everybody. I hope you liked it. I hope I, shed some light on this fund. If you didn't know about it, if you own it, I hope I put some context to it and, understand more about this fund now. Again, like the video, head down below, subscribe to the channel, and drop a comment. Let me know what video you want me to do next. And we're going to give away more premium subscriptions in April, $300 value. It's a no-brainer. Just drop a comment down below. It can be a quick one, just helps us get more views on the video. And the No BS newsletter, make sure you head down to the subscription, click the link, put your email in. It is a no gimmick, free newsletter. We send it out twice a week. We're sending out a ton of information to newsletter subscribers in terms of case studies, stock research, ETF research, anything you can think of. We're dropping it in your inbox twice a week, no spam. And again, I'll see you next time for more great videos.